Hi guys, welcome back. Last week we went over a recession. If you want to prepare for a recession in year 2023, I would strongly suggest that you watch that video. This week we're going to be talking about how to invest in the stock market and how I personally invest in the stock market. Now, I will also be going over an example just to show you what investing in the stock market can help you do with your money. Now, if you followed me so far on this channel, you know that I'm a big fan of investing in the stock market, and particularly I'm a big fan of investing in index funds. Now, why is that? That is simply because of all the research that I've done over the years. And that includes everything that I've read about investing in the stock market, the historical performance of the stock market in terms of rate of return, and the fact that I want to keep investing as simple as it possibly can be. Now, like I said, on this channel, I've talked about index funds before. Just in case you do not know what an index fund is, an index fund is basically a group of stocks. Sometimes you've heard people say, I'm investing in the stock market. I invest in a particular company, let's say Coca-Cola or Apple. Right? That person actually goes ahead and buys shares of Apple or shares of Coca-Cola. So they're investing in one company or two companies or a few companies. But personally, because I know there are risks involved when it comes to investing in the stock market, I want to mitigate those risks as much as I possibly can. So instead of investing in individual stocks, like the two stocks that I've just mentioned, and investing in them directly by purchasing these stocks, I'm investing in them indirectly by purchasing an index funds to which they belong. For example, an index fund that I invest in personally is VTSAX, and that stands for Vanguard Total Stock Market Index Fund, which is exactly what it says. It's an index fund that is comprised of thousands of US-based companies. For example, that particular index fund, the last time I checked, was comprised of 3,900 stocks. That is almost 4,000 different stocks, which include Apple, Amazon, Walmart, Coca-Cola, Procter & Gamble, Microsoft, virtually any major company that you can possibly think of. And in terms of diversification, that particular index fund is comprised of many different sectors, which include, in order of those that are weighted more to what's weighted less. Over 20% of that index fund is invested in technology companies, about 14% in consumer discretionary, about 13% in healthcare, about 13% in industrials, about 10% in financials, about 6% in consumer staples, about 4% in energy, about 3% in real estate and utilities, about 2% in telecommunications, about 2% in basic materials. You get the idea. So by investing in it, I'm investing in multiple different sectors in the economy. So how exactly do I invest? I invest by buying into that index fund periodically. And for me personally, that's every 2 weeks. So purchasing more shares of that index fund coincides with my paycheck. So every 2 weeks I get paid, every 2 weeks I invest in that particular index fund. Now, because the prices of stocks, index funds, or exchange traded funds fluctuate, meaning they go up and down throughout the year, from day to day, week to week, month to month, the particular amount that I'm investing buys more or less shares of that index fund. And a quick example that I can give you, let's say I'm investing $100 every 2 weeks. If the price of that index fund is $100 on the day that I invest in it, then $100 would buy me one share. If the next time that I invest for $100, the price of one share is $103, then I would do $100 that I'm investing divided by $103, then I would be buying 0.97 shares. So a tiny bit less than one share. And this is something that I continuously do by dollar cost averaging into the market. And dollar cost averaging is exactly what I just explained. Sometimes the same $100 would buy me more shares, sometimes it would buy me less. But over time, it's been proven time and time again that the total return that you will have earned, let's say 10 years from now, is going to be a positive number, meaning that I will have made money. Now, to better demonstrate how that works, I'm just going to give you a personal example. So I logged in my brokerage account and I went back a few years and randomly picked an investment that I made in that same index fund. So I randomly chose February 18th, 2016. So on February 18th, 2016, I purchased shares of that index fund. And at that time, one share cost $47.34. So by investing $400 divided by $47.34 gives you approximately 8.45 shares. Now, as of when this video is being recorded, one share of that index fund is being traded at $100.41. So if I do 8.45 shares that I originally purchased back in 2016, I multiply that by $100.41. It means that my total investment now is worth $848.46. So remember, initially back in 2016, I only invested $400. Now those $400, that particular amount has essentially doubled. So my rate of return is over 100%. I made an investment of $400. Now you see how easy that is. I made an investment of $400. Now approximately 7 years later, it has more than doubled. Now imagine if it's you making investments like that, but you're making them consistently. It doesn't have to be $400. It can be $100. It can be $50. Now using the example that I've just gone over, let's say for whatever reason, on that particular date, on February 18th, 2016, I had $100,000. Now, those $100,000 would literally be worth today $212,000. More specifically, $212,115, which would mean that someone who invested $100,000 in that same particular index fund 7 years later has made $112,000 in profit. Just like that, without lifting a finger, without having to deal with crazy managers, employees, without having to answer phone calls, without having to deal with irate customers if you're self-employed, basically without doing anything. That person was able to make those $112,115 simply because they own an asset, which is that index fund, and that asset has appreciated in value over time. Now, do you understand how the rich can become richer and richer as time goes by without lifting a finger? Now, that is the power of investing. And by the way, for my earlier example, those 8.45 shares, just for owning those shares, I was being paid dividends on it. And I'm going to continue to be paid dividends on it, which is going to be the other way that I make money from the stock market. And it's through dividends. So in addition to the value of your assets appreciating over time, meaning they increase in value. So $400 became $848. If the asset that you've purchased is a dividend-paying asset, you get paid money simply for owning those assets. And I'm going to exaggerate a little bit and use a larger amount just to demonstrate that to you. Let's say the same index fund that I'm talking about, which costs $100.41 now. Let's say you had $100,000 invested in that particular index fund. So you do $100,000 divided by $100.41, that gives you 995.91 shares. Let's say the dividend per share that you get is, say, 30 cents. So you do 995.91 shares times 0.30. That would give you approximately $298. So if the dividend rate were to remain exactly like it is, and the share price was to remain exactly $100.41, every quarter, meaning every 3 months, you would be paid $298 approximately just for owning those shares. So let's say the dividend was being paid on January 1st, 2023. So on January 1st, 2023, you would have gotten $298. On April 1st, 2023, you would have gotten another $298. On July 1st, 2023, you would have gotten $298. And on October 1st, 2023, you would have gotten the fourth $298. And this is simply for owning those shares. So I make money in the stock market by investing in index funds, and I invest consistently for an extended period of time. And as time passes, not only does the value of my shares increase, in addition to holding these shares, I get paid dividends 4 times a year. Now, the beauty of it, if you are in the wealth accumulation phase, meaning that you're building up your portfolio, it's always recommended that you reinvest those dividends. So in the example that I've just used, $298 that you receive 4 times throughout the year would give you $1,195. If you reinvest your dividends automatically, you basically tell the brokerage firm or the investment firm, if you receive dividends, to reinvest them into the same asset. So those $1,195 that I got in dividends would be reinvested into the same index funds. Let's say the price of one share still remains at $100.41. Then 1,195 divided by 100.41 would give me 11.87, which would mean over that year, I would have purchased 11.87 more shares, which means that those shares will have the ability to appreciate in value as time goes by and pay you additional dividends. It gets to a point where these earnings keep on getting higher and higher, and those dividends keep getting higher and higher. And it becomes a vicious cycle, but to your advantage. This is what you call compounding. If you need more information regarding compounding, please watch my video on that topic. That's it. So if this video was informative to you, please comment, like, share, and subscribe, because it really does help me grow the channel to continue to spread good financial information to get you to be more financially literate. And also don't forget to hit the bell button to be notified every time I release a new video. I'll see you next time. Have a good one.